I want to start with a promise that has quietly governed your entire financial life, whether you ever knew it or not. For roughly 40 years, there has been one unwritten rule underneath the American economy, one reflex so dependable that investors gave it a nickname and built their entire retirements on top of it. The rule was simple. Whenever markets got frightened, whenever stocks fell hard enough or the economy wobbled, the Federal Reserve would ride to the rescue and cut interest rates. Lower rates, cheaper money, and the market would recover every single time. 1987, they cut. 2001, they cut. 2008, they cut to nearly zero. 2020, they cut to zero in a matter of days. For 4 decades, the message to every American with savings was the same. Do not worry. If it gets bad enough, the Fed will save you. That reflex is the single most important force in the financial life of everyone watching this. And in 9 days, on July 29th, there is a real and rising chance that the Federal Reserve breaks it. Because right now, with markets nervous and an economy that is clearly slowing, the Fed is not talking about cutting rates to rescue anyone. It is seriously considering raising them, and I need you to understand how violent a reversal that is, so here is the number that stopped me cold this week. 6 weeks ago, the number of Federal Reserve officials who expected to raise rates this year was 0, not a single one. Today, that number is 9. It went from 0 to 9 in 6 weeks. Half the committee has flipped from "I will not raise rates" to "I will in a month and a half," and the market now puts the odds of a hike by autumn above 50%. Something has changed inside that building that has not changed in 40 years, and almost nobody is explaining to ordinary people what it actually means for them. So today I am going to show you exactly why the rescue reflex may be dead, why a trapped Fed is far more dangerous to your savings than a scary headline, and what quietly happens to everything you own the moment the market stops believing it will be saved. And I am going to take you back to 1 man and 1 year, 1979, because the last time a Federal Reserve chairman deliberately chose to inflict pain instead of relief, he changed America for a generation, and the people who understood what he was doing came through it, and the people who did not were destroyed by it. Stay with me. 9 days from now, a 40-year promise may end, and you deserve to walk in knowing it. Let me explain the reflex first, because you cannot understand how big a deal breaking it is until you see how deep it runs. The Federal Reserve controls one thing directly: the short-term interest rate, the price of money. And for 40 years it has used that lever in one direction whenever there was trouble: down. When money is cheap, meaning interest rates are low, 3 things happen that lift the market. Borrowing is easy, so companies expand and consumers spend. Bonds and savings accounts pay almost nothing, so investors are pushed into stocks to earn any return at all, which drives stock prices up. And the cost of the government's enormous debt stays manageable. Cheap money is the tide that lifts everything, and for 40 years, at the first serious sign of danger, the Fed opened the floodgates. That is why investors coined the phrase "the Fed put," borrowing a term from the options market, meaning a floor under the market, a guarantee that if things fell far enough, the Fed would step in and catch them. And here is what that guarantee did to the behavior of an entire nation. It taught everyone to buy the dip. It taught everyone that declines were temporary and always reversed. It taught an entire generation of investors that the safest thing to do, always, was to hold on and wait for the rescue, because the rescue always came. Your retirement account, the advice you were given, the confidence you were told to have in the long run, all of it rests quietly on the assumption that the Fed will cut rates when it matters. Now watch what happens when that assumption breaks, because that is what may be 9 days away. Why would the Fed refuse to rescue the market? Why would it consider raising rates into a slowing economy, which is the exact opposite of everything it has done for 40 years? The answer is that the Fed is trapped, and to understand the trap, you have to hold 2 problems in your head at the same time, because the Fed has to. The first problem is inflation. Prices are still rising too fast. The war between the United States and Iran has pushed oil up roughly 30% from its summer lows, and rising oil pushes up the price of nearly everything, because everything moves on trucks and ships that run on fuel. The Fed's own preferred inflation gauge is running well above its target, and this week official after official, from Dallas to Cleveland, warned that inflation is not beaten. To fight inflation, there is only one tool: raise interest rates. Make money expensive, cool the economy down, force prices back into line. That is the first problem, and it points toward higher rates. But here is the second problem, and it is the one that turns a difficult decision into a genuine trap. The United States government now owes nearly $40 trillion. And the interest on that debt alone already costs more than $1 trillion every year, roughly $2.9 billion every single day, more than the entire military budget. Now think about what raising interest rates does to that. Every time the Fed raises rates, it raises the cost of the government's own debt, because that debt constantly has to be refinanced at the new higher rate. So the Fed is caught between two fires. If it does not raise rates, inflation keeps eating your purchasing power. If it does raise rates, it drives up the cost of a $40 trillion debt that is already the fastest growing line in the entire federal budget. There is no clean move. There is no lever that solves one problem without making the other worse. And that, precisely, is why the rescue reflex may be dead. For 40 years, the Fed could cut rates to save the market because inflation was low and the debt was manageable, so cutting cost nothing. Today, inflation is high and the debt is staggering, and cutting rates could send inflation roaring back while the world is already questioning whether it wants to keep lending America money. The Fed put the 40-year promise that someone will always catch the market requires a Fed that is free to cut. And for the first time in the lifetime of most people watching this, the Fed may no longer be free. Now here is the number that proves this is not my speculation, that something real has shifted inside that building, and it is the number I opened with, because it deserves a second look. In the Federal Reserve's own projections, 6 weeks ago, 0 officials expected to raise rates this year. After the new chairman, Kevin Warsh, held his first meeting, that number jumped to 9. 9 of 18 officials now expect a rate hike. That is not a gentle drift of opinion. That is half the most powerful financial committee on earth, reversing itself in 6 weeks. And a senior executive at one of the largest asset managers in the world described that first meeting as, in his words, quite a jolt, and said that every meeting from here is now live for a potential hike, including the one 9 days away. The market has heard it. The odds of a hike have climbed toward and past 50% for the autumn, and notice what the new chairman himself has signaled, because it fits. Warsh has publicly criticized the old Fed for talking too much, for coddling markets with constant reassurance. His first press conference was half the length of his predecessors. He has said plainly that prices are too high. This is not a man positioning himself to rescue the market at the first sign of fear. This is a man preparing the country for the possibility that the rescue is not coming this time, that the era of cheap money and guaranteed floors is over, and that something harder is beginning. And if you have followed my briefings, you know this connects to everything. The falling gold price that the central banks are buying into, the money rotating out of the crowded stocks, the debt that grows more dangerous every month. They are all the same story, and this is the engine underneath all of it. The 40-year tide of cheap money may be going out, and when the tide goes out, you find out who was swimming without it. Now I have to stop and be as honest with you as I am in every one of these briefings, because I do not sell fear, and there is a frightening version of this that I refuse to tell you. So here is the honest other side, at full strength. The Fed may not raise rates on July 29th at all. The odds are real, but they are not certain. They are roughly a coin flip for the autumn, and a coin flip is not a prophecy. Inflation may cool on its own, especially if the war settles and oil comes back down, which would take the pressure off entirely and let the Fed stay patient. The 9 officials projecting a hike are projecting, not promising, and projections change as we just saw them change from 0. And even if the Fed does raise rates, it does not mean the market collapses, because economies and markets are resilient and have absorbed rate hikes many times without disaster. I cannot tell you what the Fed will do in 9 days, and nobody watching any screen anywhere can, and anyone who tells you with certainty that a crash is coming, especially anyone using that certainty to sell you something, is telling you exactly what they are, and you should keep your hand on your wallet. So let me be precise about what I am and am not saying. I am not predicting a crash. I am not telling you to sell anything or buy anything. I am telling you that a 40-year assumption, the assumption that the Fed will always cut to the rescue, is being seriously questioned by the Fed itself for the first time in your investing life, and that you deserve to understand that shift rather than be blindsided by it. Because the danger here is not a single scary day. The danger is that millions of people are still, unconsciously, relying on a rescue that may not be coming, positioned for a world that may be ending, and have no idea that the rules are changing underneath them. And the last time the rules changed this way, we have a very clear record of exactly what happened, and that brings me to the why year I promised you. 1979. Many of you were adults then, some of you were raising families and paying mortgages, and you remember the name I am about to say even if you have not thought about him in years. Paul Volcker. In the 1970s, America had exactly the disease it is flirting with today. Inflation was out of control, prices were rising relentlessly, and for years the Federal Reserve had been too timid to truly stop it, because stopping it required inflicting real pain, and no one wanted to be the one to inflict it. Then, in 1979, Paul Volcker became chairman of the Federal Reserve, and he made a decision that broke the 40-year reflex of his own era. He decided that inflation was the enemy that had to be destroyed no matter the cost, and he raised interest rates to a level that seems almost unimaginable today. He pushed them toward 20%, 20%. Mortgages hit 18%, and he did not cut to the rescue when it hurt. He held. The country fell into a harsh recession. Unemployment climbed painfully. Farmers drove their tractors to Washington in protest. He was hated, threatened, condemned from every direction, and he held anyway, because he understood something the market did not want to hear, that the pain of curing inflation was smaller than the pain of letting it run forever. Now here is the part I need you to hold, the part that matters for you today. The people who understood what Volcker was doing, who understood that the era of easy money was over, and that the world had fundamentally changed, positioned themselves accordingly and were rewarded enormously in the decades that followed. And the people who kept waiting for the old rescue, who kept assuming rates would come back down any minute and behaving as though nothing had changed, were punished, badly, for years. The lesson of 1979 is not that high rates are the end of the world. It is that when a Federal Reserve chairman decides to break the rescue reflex and choose pain over relief, the single most dangerous thing you can do is keep behaving as if he won't. The people who got hurt were not reckless. They were ordinary, sensible people who simply could not believe the 40-year rule had ended and kept acting on a promise that was no longer being kept. So let me bring this to your kitchen table, the way I always do, because this is not really about the Fed, it is about you, and it is about a single shift in how you see the next few years. Most of you are not going to trade around a Fed meeting, and you should not. What I want you to take from today is not an action, it is an awareness, and it is worth more than any tip. For your entire investing life, the safe assumption was that trouble is temporary, and the rescue always comes. So you hold on and wait. That assumption may no longer be safe, and the reason it may no longer be safe is not a headline or a mood, it is arithmetic, a $40 trillion debt and stubborn inflation that together may have taken the rescue lever out of the Fed's hands. You do not need to panic about that. You need to simply stop assuming it. And there is one concrete, free, no-pressure thing that awareness should lead to. Look honestly at your savings and ask a single question. How much of what I own depends on cheap money and a rising market to be worth what I think it is worth? Not to sell it, just to know it. Because the things that soared the most during 40 years of cheap money, the most expensive stocks, the most speculative bets, are the things most exposed if that era is truly ending, and you may be holding more of them than you realize. Quietly, inside funds you were told were safe. Knowing that number changes nothing you have to do today. It simply means that if the ground does shift, you will not be the last to find out, standing on an assumption that stopped being true while you weren't looking. And if that awareness ever leads you to make a change, make it the way I tell you every single time, slowly, on your own schedule, with a professional legally required to act in your interest, never in a rush and never in fear, because a real decision survives a week of calm thought, and urgency is always the fingerprint of someone trying to trap you. So let me close the loop I opened. For 40 years there was a promise underneath your entire financial life, that whenever it got bad enough, the Federal Reserve would cut rates and save the market, and everyone from Wall Street to your own retirement account was built on the certainty that the rescue always comes. In 9 days, on July 29th, that promise faces its hardest test in a generation, because the Fed is trapped between inflation it has to fight and a debt it cannot afford to worsen, and half its officials have flipped from cutting to hiking in the space of 6 weeks, and the new chairman is telling the country, in his own quiet way, that the coddling is over. I cannot tell you what they will decide in 9 days, and I would never insult you by pretending to. But I can tell you that the assumption you have relied on your whole life, that someone will always catch the market, is being questioned by the very people whose job it was to make that promise, and that the last time it was questioned this seriously, in 1979, the people who kept believing in the old rescue were the ones who got hurt the worst. The rescue reflex is not a law of nature. It was a luxury of an era of low debt and low inflation, and that era may be ending. If this showed you the promise underneath your money that no one ever names, take a moment to share it with one person who is still, without knowing it, waiting for a rescue that may not come. And I would truly like to hear from those of you who lived it. If you remember 1979, if you remember 18% mortgages and Paul Volcker and what it felt like when the easy money stopped, tell the younger people watching what it taught you, because there is someone in their 40s reading this whose entire life has been one long era of cheap money and guaranteed rescues, who has never once seen the Fed choose pain on purpose, and your memory is the only teacher who can reach them before the lesson arrives on its own. I read every single comment. I will see you in the next briefing.